We'll now move on to the equity side of the equity and liability side of the SOFP. So what is equity here? In finance, equity is ownership of assets that may have debts or other liabilities attached to them. So equity refers to the ownership of a company. So these people are the owners of the company here. 2. Equity is measured for accounting purposes by subtracting liabilities from the value of assets. Okay. So how do you find out equity value is? You take the total asset, from that minus all the liabilities, you will get the equity. So a business that needs to start up or expand its operation can sell its equity in order to raise cash, and that does not have to be repaid on a set schedule. So we can also say that equity is a permanent capital in a business. Okay. So if a company wants to raise money, it can sell their equity, get that money, and it can buy machinery. The amounts invested in a business by the owner are amounts that the business owes to the owner. Okay. See here, the concept is the owner is different and the company is different. The company gets money from the owner. Okay. So there are like two parties here. Okay. Even if you are a owner, it doesn't means that you are the company. The company is a different person. Okay. And you are a different person. The company has got its money from you. Okay. So that's how we have to consider it. So IFRS defines equity as the residual interest in the assets of the entity after deducting all its liabilities. So this is a definition. I think this definition matches this point. Okay. So we have seen like equity in various forms here. Okay. So we have seen its definition. Okay. We have also seen like how it could be used as a capital. We have also seen that the owner and the business are different. Okay. So you should have a very good idea about what is equity. So this equity shareholders, okay, are the ones who will get all the profits of the company. Okay. So they are like eligible to get all the profits of the company. So now we'll look at retained earnings. The retained earnings of a business is the accumulated net income of the business that is retained by the business till that particular point of time, such as at the end of the reporting period. Okay. See, assume you have started a company. The first year the company made 100 rupees profit. The second year the company made another 100 rupees profit. The third year you made another 100 rupees profit. So 3 years 100 rupees profit you have made. Your retained earnings will be 300 rupees, because if you have not spent any of that profit, okay, the profit gets retained in the business itself. Okay, so 300 rupees is your total amount of profits that you have earned up to today. Okay, in the last 3 years. So next year if you earn another 100 rupees, it would become another 400. Okay, so that is about retained earnings. So who gets these retained earnings? The retained earnings are eligible for equity shareholders. Okay, and the retained earnings can also be used in the business to buy assets also. So net loss is transferred from, sorry, at the end of that period, the net income at that point, which is transferred from the profit and loss account to the retained earnings account, which appears in the liability side. Okay, so every year P&L profit amount gets added to the retained earnings amount. The net loss is transferred from the P&L account to the accumulated losses account, retained losses account, which appears in the asset side. So if you have like profit, they are like added together and it becomes retained earnings. But if you have loss, what will happen? When you have loss for 2 years, we'll say, okay, minus 100, another minus 100. Both this minus 200 will be shown on the asset side. Okay, when you have profit, you showed it on the liability side. When you have net loss, you showed it on the asset side. Okay, so how can we say that loss is an asset? See, loss is not an asset. Okay, loss is not an asset. This retained loss or accumulated loss is a fictitious asset. Okay, like what we saw earlier, it is a fictitious asset. Okay, it is done only to ensure that the balance sheet tallies, or else your balance sheet will not tally. So now we'll start discussing about liabilities. So what is a liability? So a liability is a present obligation of the entity arising from past events the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. So we'll break this definition and we'll see the meaning of it. A liability is a present obligation. Okay, what is a present obligation? Obligation is something you have to do for another person. Okay, so it is a present obligation. So currently you have promised someone that you will do some kind of a benefit for them, okay, of the entity arising from past events. Okay, so you should not like say that I will I'm going to pay. I have a loan, okay, and for example you can say that I have a loan, okay, which I got last year or even yesterday. I have got a loan, but I will pay this in the future. Okay, that is fine, but you can't say that I am going to get a loan in the future which I will be again paying it in the future. See, that doesn't work. Okay, you can't say that I will get a loan tomorrow, okay, and I will pay that loan in 1 year's time. See, that doesn't work. It has to be a past event. Okay, so even if you have taken a loan 1 hour before, even that can be considered, but you can't say that I will get a loan in the next hour. Will like that can be like considered as liability? The answer is no. It should have been because of a past event. Okay, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. So the settlement of this promise, okay, should result in an outflow of some kind of a benefit. Okay, so if you want to, if you have got a loan last year and you have to pay that loan, okay, that loan in the next year, then that can be considered as a liability. Okay, because you are going to pay a money to that other party. Okay, or assume that you say that I am not going to pay money, but I will be like giving them a part of my machinery. Then is it a loan? Yes, because you have given him some kind of economic benefit. Okay, economic worth kind of thing you have given. It doesn't mean that you have to give cash only. Okay, to settle a loan you can also give a machinery. To settle a loan you can also give your shares. Okay, you can also give your shares. So it has to be, it has to be a present promise which has arisen because of previous previous uh, what to say, previous transaction it has arisen. Okay, and you are going to settle it in the future, and some kind of benefit is going to flow away from your company. Okay, the best example is a loan. You have got a loan in last year. You have made the promise to a third party that you will give the settle the loan in 1 year. Either you settle it through cash, or you settle it through machinery, or you settle it through shares. That doesn't matter, but some kind of benefit should move away from your company. Okay, so this is a detailed explanation of a liability. Have this idea in your mind so that you can easily find out what is a liability. So examples of liabilities are supplier for goods bought on credit. So if you have done any credit purchase, that's a liability. Any money that you have got from a bank, that is a liability. If you have a bank overdraft, that's a liability. If you have to pay tax to the authorities, okay, that is also a liability. On SOFP, liabilities are separated as current and long-term liabilities, okay, to help users assess the company's financial standing in short-term and long-term periods. So similar to how we split an asset into non-current asset and current asset, we can also split the liability into current liability and long-term liability. Okay, so we can also say that it can also be split in terms of current liability and non-current liability. Okay, so in India we use the word long-term liabilities, but in abroad they use the word non-current liabilities. Okay, so some liabilities are due to be repaid fairly quickly. Example, suppliers. So for some people we pay within a year, and for some people we take a long time to pay, more than a year. Okay, so those become non-current liabilities. So now we'll see like what are non-current liabilities. So long-term liabilities or non-current liabilities are liabilities that are due beyond the year or the normal operation period of the company. So you're going to settle this in more than a year, okay, or more than a operating cycle of a company. Long-term liabilities give users more information about the long-term prosperity of the company. Okay, so if a company has a good level of long-term loans, okay, that is actually good, because with long-term loans they will buy long-term machinery assets they can buy, and they can make more money out of it. Okay, so having long-term liability is not bad at all. It's also good, provided the company makes profit with it. So the examples for non-current liabilities are bonds, long-term loans, lease obligation, pension liabilities, deferred income tax, and derivative liabilities. So mostly in problems you will see only these first two. Okay, bonds, okay, which is the company uh, has issued, or like long-term loans that the company has. Mostly you will see only two of this. The balance are like for every very detailed problems you might have. Okay, so various ratios use non-current liabilities, okay, to assess how very good the company is, okay, or assess the position of the company. Okay, so non-current liability is used in ratios such as debit to asset ratio or debit to capital ratio. Okay, so non-current liability uh, will be assessed, okay, by many people, okay, to find out whether the company is able to pay the interest, whether the company is able to pay the liability properly on time. Okay, that and all will be checked. So now we'll move on to current liability. Current liabilities are a company's short-term financial obligations that are due within 1 year or within a operating cycle. So we are going to settle a current liability within a year or an operating cycle. So current liabilities are typically used for settling. Current liabilities are typically settled by using current assets, which are assets which are like to be used within 1 year. Okay, so we use current assets to settle the current liability. Okay, current liabilities can also be settled by creating a new current liability, such as a new short-term debt obligation. So assume that you have to pay a creditor, you get a bank loan, okay, short-term bank loan, and you can pay. So it's not that you have to use an asset to pay off a current liability. You can also get a new current liability to settle off a old current liability. So example of current liabilities are outstanding expenses, outstanding interest, overdraft, short-term loans, dividend payables, income tax payable. Accounts payable or unpaid suppliers invoice is the largest current liability on the financial statement. Okay, so there's something called an accounts payable. Usually we will come to know it as uh, creditors. Okay, we can call it as creditors, bills payable, or accounts payable. Companies try to match dates so that receivables are collected before the payables are due. Okay, so what happens is here you have a current asset called as receivable, which is debtors. Okay, so you say that customers have to repay you within 10 days. Okay, and you also tell your suppliers that we will pay the suppliers in 15 days. Okay, so what happens is you sell the items and get the receivable in 10 days time, and you make the payment to your suppliers in 15 days time. Okay, so you are using the creditors money, but you are also like encouraging your customers to buy on credit. Okay, so this is what usually companies do. For example, a company might have a 60 days terms of money over to their suppliers. Okay, so suppliers are giving 60 days of time to make the settlement, which results in requiring their customers to pay a 30 days term. So the difference of 30 days, the company can actually enjoy. Okay, they can enjoy the money of suppliers. Okay, because like they have still 30 days to pay, but at the same time they have got the money from their customers in 30 days time. Okay, so this is about the current liability concept. So now we look at what is a provision. You would have heard the word provision. Provision refers to the amount that is reduced from the profit to meet a probable future expense or a reduction in the asset value, but the exact amount is unknown. Okay, see, we create a provision when we are not absolutely sure that there is a loss. Okay, when we are not absolutely sure there is a loss. Okay, for example, we either uh, take some money away from the profit, okay, to know when we know that there is going to be some kind of an expense in the future, but we don't know the exact amount. Okay, and we come to know that there will be a reduction in the value of an asset, but again we don't know the exact amount. Okay, so in that times only we can create a provision. Okay, so provision should not be confused with savings. We are not saving anything here. Okay, the savings actually is the retained earnings. Okay, not provision, but it can be regarded as a reserve for upcoming or future liabilities. So in future you are going to have some kind of a expense. For that you are trying to save some money. Provision is accounted like a reserve. Okay, but reserve and provisions cannot be clubbed together. A provision is set up to cover probable future liabilities, while a reserve is part of the profit that is set aside for assisting the company's growth and expansion. So when can you create provisions? You can create provisions when for doubtful debts, depreciation, for pensions, restructuring liability, while paying income tax or product warranties. See, in all these situations, okay, you are not very certain about the amount, okay, because you think that receivables 5% might not be will not come. Okay, receivables or your debtors 5% might not pay properly. Okay, or you feel depreciation can be a little bit higher or lower, so you are like only creating a provision. Income tax, you are thinking that you have to pay income tax of this amount, but you cannot be exactly sure because the income tax can be different. Okay, product warranties, you have given product warranty guarantee to your customer, but you cannot be sure how much of them will come and ask for that guarantee or warranty. Okay, so see, you are partly sure and partly you are unsure. Okay, what is going to be the amount that has to be settled? At that time only you can create a provision. A provision payable within a year is a current liability. A provision which is going to be payable after a year, that is considered as a non-current liability. Okay, so provision can come in any part of it. Okay, it can come at a current liability as well as a non-current liability.